Okay. Yep, we are live.
All right. Hey guys, we're so glad that we're here today to be with you and spend some time with you. We always love to do these lives to answer your questions about credit, give you some information that you may not even had a question about because you didn't know to have a question about. So we're looking forward to doing that today. I'm Alicia Alt. I'm co-founder of Credit Score Pro, and I'm here with Ivory Becker, also co-founder of Credit Score Pro.
All right, well, we'll just jump right into it. I'm going to go ahead and share my screen and we'll pull up today's live topic. And let me know if the sharing doesn't work because we know I have technical difficulties with this sometimes. How does it look on your end, Allie?
We're good now. Yep.
Okay,
Great.
perfect.
Mhm.
All right, so today's event is Credit Scoring 101, What Nobody Tells You. And Ali introduced herself briefly, but at the beginning of every live, we like to remind you, especially if you're new here, who we are. So we are co-founders of Credit Score Pro. We're both experts in the credit repair and credit education space. My background is primarily working in regulatory compliance when it comes to default, working in the lending space, credit repair, really anything that has to do with credit reporting and potential delinquency on accounts is my background. And Allie, I'll let her share a little bit about her background.
All right. So again, I'm Alicia Alt, again, co-founder of Credit Score Pro, and I have an extensive history in the credit industry and lending industry, 20 plus years now. I started as a teacher and kind of transitioned into the lending world and did that for several years. I did manage my own mortgage broker shop and then transitioned into credit repair. So I really love this space, and I'm looking forward to this webinar to teach you a little bit more about how credit works.
All right, so why are we here? Well, credit influences almost every single decision that we make, from housing, whether that's renting or buying. Certain types of employment require credit checks as well. Your insurance is impacted by your credit, your ability to obtain utility bills without having to put money down, as well as even things like cell phone financing. And then just the thing that we're most familiar with is any sort of borrowing, right? Getting a credit card, getting access to auto financing, really any type of debt application. So let's start by looking at some of the numbers. I always think it's fun to dive into some of these statistics because it really puts things into perspective. So 19 million adults lack a credit score. This is known as being credit invisible. This can be from fear of utilizing credit, or it can also be from age. Older adults, as they become elderly, tend to become credit invisible. And often we find in those scenarios, at some point, they may need to access their credit again and need to reestablish credit. 37% of adults have a credit score below 700, which that number may be astounding to most. It's quite a high percentage of adults within the US that don't have that higher credit score. And 16% of those adults are below that 579 credit score.
Mm.
And would you guess the state with the lowest credit score is the state of Mississippi? And the
Interesting.
average score in the state of Mississippi is actually 680. So it's still a pretty high average. When we look at the median credit score, it's quite a bit lower than that 680 range. But the lowest is Mississippi out of all of the states. And 22% of adults have a credit score over 800 plus. And I want to look at some of the characteristics of those that are in this 22%. They tend to have more credit cards than the average American, an average of 5.9 credit cards compared to 3.9. Remember, we're looking at averages, so obviously I know you can't have a partial credit card. Um, they have a lower credit card balance, average balance of $2,558 with those with an 850 or higher, or well, I guess 850 is the max, with an 850 credit score, compared to an average balance of $5,221 for all consumers. Now, those balances are a little bit out of date. We're actually seeing higher average credit card balances across the US, but some of those statistics haven't been fully refined yet, so we're not using those in today's presentation. They also have higher personal loan balances, averaging $32,872, compared to $17,064 for all consumers. Now, those loan balances are any type of loans, so I want to kind of correct myself when I say personal loan. I'm not specifically talking about a personal loan. We're just identifying business versus personal. And they have no delinquent payments that would show up on their credit report as compared to the average American, who has 1.8 delinquent payments. So the average American has about 1 to 2 delinquent payments showing up on their credit report. So some fun information here about the characteristics of those with an 800 plus score.
I really like that information because I think, when we're talking about someone who has a credit score that is subpar, 600 lower, they can probably relate to those numbers and say, oh, wow, you said even those people at that lower range having 1.8 delinquencies on their credit report, and they probably have 10. We have people like that all the time. And so it kind of really puts things in perspective. Like when you get in that 800 plus, there's 0. And you
Right.
have 10, that can kind of give you an idea of where you're falling in that. So that's really valuable information. Thanks for sharing that.
And 1.2% of adults have that perfect credit score of 850. So it's a very small population. And the majority of those that make up that 850 are the baby boomers. They account for 59% of adults at that 59% of that 1.2%. So over half of the people at that 850 score are in the baby boomers. And at a Gen X is 22%. And the silent generation's 14%. Younger Americans are not likely to have reached the pinnacle of that 850 score. Only 4% of millennials and 0.1% of Gen Z have obtained that perfect 850 score.
And I think there's something very pivotal to that information. When we talk about getting to that 850 score, you can have great credit as a millennial, for instance, and have no delinquencies. You got the perfect pie of credit, right? Everything's perfect on there, but you don't have the 850, and that's because we need that age. And I think that's why you're seeing that the baby boomers and stuff like that, they're at that 850 because they also have, the great credit standing, but they also have that history of long-standing credit. And
Longevity,
that's,
right?
yeah, super important. And I think that was important to point out because I've had a lot of clients come to me and they're like, what's your credit goal? And they say 850. Like, that's not going to be possible. Let me tell you why, right? Unless I age you, that's not possible, but let's get you to a possibility and get you ready for that 850.
Right, because there's so many other factors you can control that can get you to those higher score ranges.
Correct.
So
Except I
Allie,
don't want to get older. I'll forgo the 850. I do actually have an 850 score, and I like to talk to people about this, not to brag about that, but I think when you walk the walk, right? Talk the talk, walk the walk. But I have an 850 score, and I know a lot of credit professionals who don't have an 850 score, and nothing wrong with that. Like they did everything right with credit. But again, I have this really long history, so again, a testament to I'm old, first of all, but I've
You're
had credit
not
cards
that
for a
old,
long
Allie.
time, and I got to 850, so I graduated.
Now, Allie, what state do you think has the highest credit score, the highest average credit score?
All right, I'm gonna go with Florida.
Nope. I'll give you one more
No,
guess. One more
okay,
guess before I show you.
one more guess. Okay, let me think. Hold on. I'm gonna go with Ohio.
Minnesota.
Minnesota. You know what? Actually, that would have probably been my third guess, and it probably should have been at least my second guess. Um, that makes a lot of sense. Also, Minnesota is a if we were to look at the statistics of like wealth, that's a very wealthy state, and I think that
Mhm.
kind of goes hand in hand with
It
credit
does.
scores.
It
Yeah.
does. It's actually not something I did include in today's presentation, but income and the credit score tends to correlate. specifically because, of course, it's easier to maintain your financial obligations. It's easier to pay bills on time if you have more income. And that average credit score in the state of Minnesota is actually 742. So it's a
Wow.
really, really high average. The
Yeah.
closest under it was 735 or 737, one of the two. And unfortunately, I can't remember what state that was off the top of my head.
Yeah. And I think it's important to, even point out, we said Minnesota has those higher credit score averages um, because it's a wealthy state, right? We know that. But it's important that you know as a consumer that your income does not has any bearing on your credit score. You can have an
Right.
850 and make no money, right? That's completely possible. It's the reason for that when we say that they're more affluent, so they have better credit scores, is only because they uh, I lost track, is because again, they don't need credit. They're not utilizing it as
Mhm.
much, right? And
Right.
they're able to pay their obligations.
Right. Right. Okay, looks like we don't have any questions so far, but just a reminder for those of you attending here live, you can put questions in the chat and we will make sure we answer those throughout today. Especially if you're new here, we recommend you asking your questions. We want interaction. Today's live and every live going forward, we do these every other Thursday, are meant to help you. So help us help you. All
Right.
right. Since we're done with the fun statistics, let's go ahead and switch gears to talk about what a credit score is. Um, maybe. There we go. So, what is the point of a credit score? It's really meant to show the ability to pay creditors responsibly. Credit looks at your reliability through multiple different lenses. And we're going to explore that in more detail because I don't think this is something that is often really dived deeply into, excuse my grammar there. But we know that credit is a number, but what does that number truly represent? So credit scores are used to compare the credit worthiness of different individuals. Each person's score is a reflection of their own credit history and their own behaviors. But when lenders or other entities are looking at the scores, they're using them to compare one's consumer credit risk to another consumer's credit risk. So it's a dynamic comparison. Credit scores are dynamic, meaning they change over time. They change based on your financial behavior. Even if you had a late mark that occurred, let's say last week, as it ages on your credit file, it can become less impactful and less important based on your new behavior being more positive. Let's say you haven't missed any late payments, you haven't had any late payments in the last 2 years. You're going to notice your score positively impact from that stronger behavior. So this means a consumer's rank order in terms of credit worthiness improves or declines based on their behaviors.
Okay, I have someone who has like kind of a story and kind of a question.
Sure.
So they talking about the dynamic comparison, I think is where this correct question is coming from. But they had a high credit score last month, and then they went over the limit on two of their cards because of Christmas. And now their
Mm-hmm.
credit score is in the 500s, and they don't understand why just those two credit cards, with all their other good stuff on their credit, it would cause that big of a drop.
Sure, sure. One of the factors that impacts your credit score is your utilization ratio. When you have maxed out a credit card, you've gone over limit. That ratio is now 100%. When you've gone even beyond your limit and you're over limit, as Ali had mentioned, you're over 100% utilization on that card. Uh, the utilization ratio is 30% of your credit score. So it's the second biggest overall factor impacting your credit. So once you pay that card down, you're going to see your score recover. And that really shows that dynamic aspect that we're talking about. Those changes in behavior over time are going to reflect. So once you pay that card down and the creditor reports your balance is now paid down, it's going to signal that you're no longer at higher risk, right? You're not spending excessively, and your score is going to reflect that change in behavior to be lower risk, meaning a higher score.
Yeah, and just to add on to what Ivory said, I see this a lot, where especially in the Christmas season, right? Because we're spending money on our credit cards or whatever. But I see this a lot. It can be as much as 100 points or more that you lose
Sure.
just because of that kind of and have great stuff otherwise. So thank you for that comment in chat. Just so you know, just like what Ivory said, just kind of sum up what she said. Once you pay that down, you get those points back. They're not lost
Right.
points, right? If you had a missed payment, that might be lost points for a time period, but
Sure.
this is not lost points. You'll get all that back.
Absolutely. Relative positioning. So it's important to understand that your credit scores don't exist in a vacuum. So what I mean by this is there's multiple different types of credit score algorithms. Think of them as different report cards, different ways to assess your credit worthiness. So there's FICO scores, which are the standard, and then there's Vantage scores. So in understanding that there are different score models, your ranking in those score models may be different as well. And it's dependent on where you're applying for credit. Let's say you're applying to rent an apartment. They may be using that Vantage score rather than that FICO score. So they may look at your credit and say, let's say a 700 there, they're saying, hey, that's a really great credit score. Whereas someone else using the FICO score algorithm may not look at that 700 in exactly the same way. So another thing to consider, I don't know, actually, before I go into that, was there anything you wanted to add to that, Allie?
I think, very important to know that they are different ways of scoring the same information. So your
Right.
information is not different on those two reports.
Right.
It's just that the information, how it's scored. So, when you think about mortgage uses FICO, they use an old outdated system, right? That no one uses anymore except for mortgage companies. And unfortunately, this one is what I call it. I like to just call it the mean one, right? You're going to have lower scores. If you're looking at Vantage scores, which are traditionally your credit monitoring scores, which are perfectly fine,
Mm-hmm.
it's just not going to show you exactly what your mortgage credit scores are. And I think that's important for people to know.
Mm-hmm. Right. And another aspect is the same score can mean different things depending on the overall credit environment. So during economic downturns, lenders tighten their credit standards, making previously good scores less competitive. Ali, I'd like you to talk a little bit about that, specifically with the mortgage space and how you see the minimum credit scores changing um, within the mortgage industry.
Yeah, I've been in the industry for a long time, so I've seen a lot of changes. And you're exactly right. When things get rough in the environment, the lenders tighten their belts really tight, and not just in score, but for the score, but also for just their lending guidelines in general, like what we call overlays. But what I would say for this is, when I got into the business, if you had a 600 score, we were giving you a loan all day long. You could have judgments; it didn't matter. One day out of bankruptcy, it didn't matter. It's very different today. The belts are tightened. So not only do we want to see high credit scores, but we also have, you can't have judgments outstanding, unless you have a payment plan. You can't be one day out of bankruptcy, right? There's different overlays on top of this credit score. But like right now, today, if you want the best interest rates, you have to have a score of a 760 or higher. Well, just a couple years ago, that number was 720. So we're
Mm-hmm.
changing quite a bit.
I remember seeing the climb because I was surprised when it jumped up to 740 and then surprised again when it jumped up to 760.
Yeah, yeah. And I have lenders who send me all their clients that are below a 720 or 720 or below. And I'm like, this is crazy. A 720 was like your ticket, red carpet, right? And
Right.
that's not the case. 760 is red carpet. And that's why I call the red carpet. So if you want red carpet and you can get a yes to everything you want, you want to shoot for that 760 range. And one thing that's important, we talked about that 850 being the highest credit score, right?
Mhm.
It doesn't necessarily do you need an 850. That 760 will give you everything that 850 will give you. And 760 is possible even for someone who's younger versus
I
that
think that's
850.
an excellent point to make, and probably a question a lot have had.
Oh, I'm sure. Yeah. So strive for the 850, but get the 760 for sure.
Exactly. So let's dive into those components that make a credit score. Um, we have 5 primary factors that determine your credit score, and that's regardless of those different models, right? Regardless of the Vantage score, regardless of the FICO credit score. They're all looking at these 5 primary factors. So remember, your credit score is the mathematical interpretation of these factors that represents your quote unquote credit worthiness. I'll let you dive into the factors.
Oh, you'd love to give me the factors. And then
You want me to do
say
it?
them out of order. No, I'm just kidding. So, so the top of the line is the payment history. That's 35% of your credit score. Note that this is the highest one. It's also one of the most important ones. Do your payments on time. Simple as that. If you have good payment history and you're paying your things on time, you're going to have good credit, period. Okay.
Now, Allie, when
Yes.
are you marked past due on your credit report?
Ah, good question. So it's 30 days past due. And that's a really good question because I'll have people say, Allie, I think my credit score is going to take a dive. I was late on my credit card. I'm like, how many days? 15. Oh, yeah, I don't care. It's got to be 30 days. So, and that this is probably for another day, but just a little tip for the night. If you do have a credit card and you are 30, 31, or 32 days late and you are not notorious for that happening, you can call the credit card company up and oftentimes they will remove that late payment as a courtesy. So just a little pro tip. All right, so back to this. 30% is based on your credit score. 30% of your credit score is based on how much you are using of your credit. That's at utilization. And this is where the credit cards become a very important part of the pie. So as that one chat had mentioned about going over the limit because of Christmas, this is where it is. This is 30% of your score. Okay. 15% is your length of credit history. We talked about that. To get to 850, you usually have to be old like me. I'm just kidding. You have to have some longevity in your credit. And then 10% is the type of credit used. So we want to have a mix of credit. I call it the perfect pie of credit, having at least two open installment or two open credit cards, two open installment credit cards. I'm sorry, two open credit cards and two open installment loans and a mortgage. That's kind of the perfect pie of credit. Not that you have to have all of that. That's just the perfect pie. But that makes up 10% of your credit. And then new credit being 10%, meaning when you're opening new credit, those credit inquiries can be a factor. Also, it can decrease the average age of your account. So you have to be very careful about opening new credit. So knowing to do that if it's necessary and if you need necessary for your credit and if you need it personally. Does that
Allie,
cover it good, Ivory? Yeah.
yeah, we do have a question in the chat. Regarding amounts owed, how quickly is the credit report updated after you make your payment to your credit card company?
All right. So that's actually a little bit of a hard question, other than I can say typically 30 days. But it also has to do with your statement date and when they report to the credit bureaus. So we have a resource actually within Credit Score Pro that we use Smart Credit that's linked to Credit Score Pro. And we can actually give you the dates of when is best to pay it. So it will represent that on your new credit report. So you'll have to check that out.
Yeah, so basically your creditor isn't sending your balance every day to the bureau. It's one specific day of the month that they're sending that information.
Correct. Yeah. And it could be a different date of the month. It's not like every creditor sends it on the 30th day of the month.
Right.
And so people don't understand that. But yeah, that's a great question in the chat. Thank you for that, because this is a question a lot of people have actually, or concerns they have. They'll pay their credit card and they're like, wait a minute, you don't see that I paid my credit card. I'm like, when did you pay it? A week ago. Okay, that makes sense. I probably won't, you know. And people think it's like instantaneous, and it's not.
Right. Right. And we had one other question in the chat. For the length of credit history, this person said that they have several accounts on their credit report that are 10 years old, but it doesn't look like they're impacting their age, because with their monitoring, it says their average age is 2 years. Why would that be?
So that sounds like to me that you're not using the cards and you don't have activity on them. That's what I'm thinking on that. You have any take on that, Ivory?
It looks like they're saying they're closed accounts. So
Oh,
gold auto
there we go.
loan was one of
Yeah.
them.
Yeah. So unfortunately, and Ivory's really great at speaking on this too, but once an account is closed, it's no longer a part of your average age. It's gone. And so, one thing I'll get this a lot, and I think Ivory, you probably do too. People will say stuff, and I cringe at this when I was a loan officer. They would call me up and like, hey, Allie, I'm so excited. I paid my car loan off. My credit score should go up. And it's the opposite. It most likely will go down. And so once an account is closed, it takes that out of that activity, it takes it out of the average age. And if you don't have anything else, let's say that the auto loan was your longest history, now your score is going to drop. So that may be indeed what your issue is that those things that you have open, unfortunately, are old. And, by the way, once they're closed and they're, coming to approaching that 10 years, they will be removed from your credit report as well. No one will even know that you had that great credit in the past.
And that's why some people become credit invisible, as I had mentioned earlier. Those older individuals, usually it's going to be the elderly, have stopped using credit. They don't have a need for it anymore. And the accounts age off the credit report and they no longer have credit scores. So, yeah. Last question we'll answer for now, and we'll get to some of the other questions during the Q&A later. It looks like it's about the types of credit used, mentioning how they didn't want to have loans open unnecessarily, to impact that credit mix. So I
Okay.
think you want to take that one, Allie?
Oh, it's up to you. If you want to take it, you can take it. Either one. I
Um,
thought you were giving it to me.
oh yeah, you do it. You go for it. And I can add on the end.
Yeah, and this is important because I talk about the perfect pie of credit a lot. And one of the things that you didn't hear me say after I said the perfect pie of credit, because we have limited time, but um, we don't just get things because it's the perfect pie of credit. You can
Mhm.
have amazing credit with just credit cards. Okay. But let me tell you the flip side of it. You cannot have amazing credit with just loans. And so when you're looking at the perfect credit pie, really put stock into having credit cards. They're harder to manage and they have the utilization factor in them. And so they help to impress your credit score faster and
Mm,
better than anything else. And if we talk about the mortgage, so I talked about perfect pie of mortgage, you don't have to have a mortgage to have perfect credit. But if we had two people who had identical credit reports and one had a mortgage, but the other didn't, so everything else was identical, the one with the mortgage would have a higher score. Why? Because there's a heavier risk to a mortgage than any other thing that you could have on your credit. Okay. So no, you do not have to have installment loans. But if you find that that's part of the mix that you don't have and you want to see how that works for your credit, if you go to creditscorepro.com, or excuse me, creditscorepro.ai, please, there is a resource page for credit building resources, and there's something called the self loan. And the cool thing about this is it's going to report to your credit report like a loan, but it's actually a savings account. You're going to put
mhm.
money in it each month into a savings account. At the end of the term, which I think there's 24-month and a 12-month term, at the end of the term, you
There's
get that
longer.
money back. There's longer ones too.
Hmm.
Okay. And then you get that money back at the end of the term, minus some fees that they charge for putting out on your credit report. So it's a great way to not have to get more credit out.
Hmm.
And you're actually saving some money that
Hmm.
you might not have done if you didn't have that. Okay.
Right. And we've had several individuals use that as a tool to save money for the down payment, because you can choose to save as little as $25 a month, or you can choose to save more. So if you're someone that has trouble saving and maybe wants to get ready for a new loan payment and get that repetition in, it can be a good way to achieve that.
Oh, I agree. That's excellent. I didn't even think about that. That's an excellent idea. What a
Yes.
great resource. So not
Yes.
only do you get to start to save money for that down payment, but you're
Mhm.
also showing that on your credit report as an active account. That's a pro tip there.
Right, right. And we've had some who will save a very large amount per month, because they want to practice what's a mortgage payment going to feel like. And they'll set, a 1-year term, and now they have this huge down payment saved up, and maybe they don't even have to use all of it for a down payment. Maybe they can set some of it aside for new things they want for their new house when they move in. So,
Yeah. Or if you listened to me long enough or been around me long enough, have your 3 months reserves.
oh my
So maybe
goodness.
maybe that's even a
I
good way
actually
to
say
start doing
six
that.
months. I
Oh
say
yeah,
6 months to a
absolutely
year.
6 months. But let's start at if 3 months makes it feel, yeah, let's start there. But this is important and people don't have it. Now we're in this downturn economy and people are scrambling. And if they had done the work before, they probably feel a lot more comfortable right now.
Hmm. Yeah, exactly. Okay, we're gonna hold the rest of the questions till our Q&A later. But don't worry, we will get back to you. I know that last slide's always a popular one. Ooh, I went too far. This is always a popular slide, and we do have several different lives that are focused just on looking at this algorithm in more detail. So The credit score ranges. So most scores fall between really 350 and 850. There are some older algorithms that go down to 300. But for the most part, you're going to see between the Vantage and the FICO score anywhere from 300 to 850. I have only ever once seen something within the 300s myself. I don't know, Allie, if you've seen anything within the 300s, but for the most part, we tend to see the lower scores in the 400s to 500s range. And middle of the road, as you can see on this chart, tends to be in the 600s. And then you start etching up to the good credit scores and the excellent credit scores as you get into the 700s and then eventually the 800s. But yeah, I mean, it's pretty straightforward there. This is the range. This is how you're rank ordered against your peers. When you start seeing the green, it's good.
Yeah,
So,
love the green.
so we had mentioned this webinar is all about the things that nobody talks about, and that's what we're going to really start diving into. So these are some of the factors that are rarely discussed when it comes to credit, especially if you're lurking around TikTok or Instagram and viewing all of the fun social media
Mm.
videos. Okay, so FICO is not the only credit scoring game in town, and we've talked about this a little bit already. We've got the FICO score, which is the standard, but again, it's not alone. The Vantage score, which is a very strong competitor, starting to etch into the FICO space and actually starting to get its toes dipped into the mortgage industry. And we'll talk more about that as we see that transition take place. That in and of itself is its own live event.
Yes.
And then we have what's known as industry specific scores. Now, industry specific scores are used in industries like auto lending or credit card lending. They may be using a FICO algorithm or a Vantage algorithm, but they're very focused on that niche or that very specific industry. And outside of that, there's also alternative data scoring models. So these are newer models that incorporate alternative data like your rental payment history, your utility bills, your bank account information. And those are aimed at helping to determine creditworthiness for someone with limited credit history. It's very widespread in the use in the rental market, for example. So, anything you would like to add about any
Only
models?
on the industry specific scores.
Sure.
I had someone tell me they had 950 score, right?
Mm-hmm.
On any model that we know, that's not a score, right? So when I dived in a little bit deeper, that was their, I believe it was like Vectron or Verizon Wireless or something like that
Mm-hmm.
score. So some of those different entities also have their own scoring.
Yeah. So they have like
So
an alternative data scoring model.
right. And insurance
Yeah.
companies for, when you go get car insurance and
Mm-hmm.
homeowners insurance, they have their own scoring as well. So
Right.
it's important to know that because you're going to hear all kinds of numbers and you're going to. So the next thing you ask when someone tells you their number is either what scoring model are you using
Mm-hmm.
or what's your ranges. And then that will let you know where you fall.
Right. Right. Exactly. There are many different bureaus out there that collect data on us as consumers that can be used to create these alternative scoring models. So, but just know the standard, the main score used is your FICO score when you're applying for any sort of debt. It's used in about 96% of credit decisions. So,
And specifically, we talk about FICO scores, but most of your credit decisions are based on that FICO 8 scoring model,
right.
with some variations to it, but it's primarily the FICO.
So I guess I'll dive into that slightly. When Allie says FICO 8, there's different iterations. Think of it like your iPhones. You have multiple generations of your iPhone. It's the same with any of these models. They make a newer, better version, and then those newer, better versions start to be used by the industry. So when she was mentioning earlier how the mortgage industry has kind of the mean version, it's one of the older versions of FICO. So hopefully that all makes sense.
Yeah.
Okay. This is a common question both of us get. My credit report has three scores, right? I've got Equifax, Experian, and TransUnion, but they're different. Why is one score 680 versus another 700? And then the other one's even higher at 715. That seems like such a wide variation. Why is that, Allie?
Well, and you have the key points on the slide.
Yeah.
So but not every creditor is going to report to every credit bureau.
Mhm.
And so it can vary. I mean, I've seen credit scores where someone had a 700s and one and then 600s and 500s. Like, I mean, I've seen that. And it's because the collections were all on one of them, right?
Exactly.
So that certainly can happen. Absolutely. So not every creditor. So each bureau has their own reporting, and each creditor can decide if they're going to report to all three. So your major credit cards, your major mortgages, all those types of things, you're going to report to all three. So you can pretty much guarantee that. But the smaller creditors and the smaller, like, and the credit collection companies don't always. And so that's
Right.
important to know.
We've had individuals come to us before who have exclusively done all of their business at a smaller credit union that doesn't report to any of the bureaus.
Mhm.
And this has left them credit invisible, which is a very difficult situation when you think, I've done business with them for 15 years and now it's done
I have
nothing to help
nothing.
the credit
Yeah.
score.
That's a
So
really sad story. I've had clients that use smaller credit unions where it's reporting to two and they're missing the
mhm.
third one. That's still impactful. Like, but to not have all three is really, well, that's really sad
And it looks like we have a question in the chat. Why wouldn't they report to all three bureaus?
because they don't have to.
They don't have to,
But
and because it costs money.
it costs money, and
Yeah.
there's a rigorous reporting. They have to do these. Like, if you're disputing it, they have to report back to Equifax. If you're disputing Equifax and TransUnion, you know what I mean. So they have a lot more work to do if they're reporting it to all three. So
Which all comes down to money, right? Cost of resources to do all of that, cost of
right,
compliance. Um,
yeah.
so
And that's why the smaller companies will forego that. And they
mhm.
know that even if they're reporting to one, it could be a major hurt to your credit.
Right.
So, they feel good about that.
It's leverage still for them.
It is.
So some creditors another factor. So again, remember we're talking about the factors rarely discussed. So another thing rarely discussed is some creditors look at other financial indicators, not just your credit score. This is really overlooked. So I know we're deviating a bit from credit scores here, but I felt that this was an extremely important aspect to bring up. So Allie, let's talk about that with respect to mortgage lending specifically.
Oh, so I have so many stories I could tell you, but I'll kind of concise this. But on the screen it talks about if there's tax liens or other liens filed against you. Obviously, in the mortgage industry, we're looking at your credit score, but we're also looking at public records. That we do pull a LexisNexis report. We're looking at that to see if you have any judgments, tax liens, and things of that nature that could absolutely 100% get you denied for that loan if you have not handled those in any way, shape, or form. Either paid those off, settled those, and or have a payment plan. However, you have to have the payment plan for at least 3 months. Some require 6 months, and you also have to factor that into your debt to income ratios, which then could keep you from being able to qualify. So I call them overlays, right?
Mhm.
There's your credit score, and then there's all kinds of different things we're looking at. A good one, I think, a good example is lack of credit. So in the mortgage industry, we really need to see credit for 12 to 24 months to make a good credit decision for you. There is something called non-traditional credit that we can look at, but it's a hard press thing. It's not a fun process, and you better have good credit scores otherwise. And so I think this is an important note because I get this question a lot: why have a good credit score, but why can't I get a home loan? And I'll just make out one other point. I had a client, he had amazing credit, 700s, great. He went to Lowe's to get a credit card and Lowe's denied him. So he called me to ask me why. And it was because he had so many credit inquiries. But the thing that was really
Exactly.
interesting to me, they were all autos. So he went auto, auto, auto. Well, in our world, if you have your loan pulled for several different autos, that's okay. That's not going to decrease your credit score. Okay. In that namely 30-day period of time. But sometimes creditors look at that and they don't really put the pieces together. Oh, he's shopping for a car. And they just go, oh, crap. He just had his credit pulled 100 times. And this guy was looking for a car for his wife. And now he can't get a Lowe's credit card, even though he has a credit score of 700s. And that's pretty shocking when you come up with that type of thing. But that is absolutely 100% true.
I want to expand on that. Some of that is also due to creditors not knowing if you are actually getting a new loan or not. So we've seen that in the case of credit cards, where someone applies for 5 different credit cards at once and then gets denied because there's so many inquiries for credit cards. That credit card company that denies them is saying, whoa, 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 they might need access to debt too much. This might be a risk for us to lend to them if they're trying to open 5 credit cards at once. They might be having money problems. So sometimes it goes beyond the standard, right, of just the score. It's the activity that's happening on the report that generates the decision. And then just to go to the top point, creditors also pull reports from other systems. There is a system called check systems. So if you have issues, let's say with checking accounts, any sort of deposit accounts at a bank, and they were left in negative standing, that could prevent you from being able to open new accounts at a different bank. So that's just one common example I would see where, let's say you have a great credit score, but you've unfortunately got that blemish in another reporting system, you still may be impacted elsewhere.
And just to expand on that just a little bit is
Sure.
if you had a, let's say you had a credit card with XYZ credit union and then you file bankruptcy, you've repaired your credits and several years
Mhm.
later, and you go back to that credit union, they have a red flag on you that you have filed in the bankruptcy and very well will deny you from getting another credit card with them. I have seen some credit unions say, hey, we will give you another one. You got to pay off that balance that was in
Right.
bankruptcy. I mean, that's something that
Ooh,
does absolutely happen.
I don't know if they can actually do that.
They can, after the bankruptcy is over, they can ask for it. That's my
Ooh,
understanding.
interesting.
Yeah.
We might
To
have
give
to
them
check.
an
We might have to
yeah,
check
to
into that more.
check into that more. And that's to be able to open a new account with them.
I know there are certain places where they'll have like a timeline requirement too, where it just needs to be so many years from the charge off or so many years from the bankruptcy before they'll allow to extend credit. It may not be a done deal forever for the rest of your life. So,
Now, that being said, if you default on the Capital One and you go back to get another Capital One, you probably can get it. So
yes, there are certain creditors out there.
yes.
Okay, this is just an interesting one. So the Federal Reserve conducted an interesting study where they followed 15 couples, where they followed couples, excuse me, not 15 couples, where they followed couples for 15 years to see how their credit scores affected them in committed relation. Let's try that again. The Federal Reserve conducted a study where it followed couples for 15 years to see how credit scores affected those committed in relationships. It found that people who were equally ranked when it came to credit scores were more likely to stay together. So the closer your credit score is to your spouses when you get married, the higher the chance the marriage will last. Now, I found that just really interesting when I stumbled across that study, and you can find it online. It's all published. You can download the PDF. But we've had several people come to us where their spouse or future spouse gave them an ultimatum that they had to fix their credit before they would go through with the marriage. So this study is really showing that maybe that's a good idea. They do fix their credit before they get married, and they're more likely to stay together. Um, we hear that finance is one of the main reasons leading to divorce. And this is just a different type of study looking specifically at credit, which can have an impact or is in a result of your financial habits, right? Your ability to save and spend wisely. So I just thought that was an interesting
Yeah,
study.
I like that one a lot. And I think it's absolutely 100% true. And I, just in my line of business, I'll have clients that are husband and wife, and then they'll divorce, and then one of them's calling me because the other one messed up their credit rate.
Mhm.
And tends to be the issue with the marriage was about credit. And if you look a little bit deeper and talk to the people a little bit deeper, it's not necessarily the score, it's the financial
Right.
responsibility that those people have or do not have. So if you
Mhm.
have two people who are financially irresponsible, they probably are okay together. But if you have one who's really financially responsible and the other one's not, there's going to be a conflict there,
Mhm.
right? And I think that it's absolutely 100% true, and that's
Yeah.
probably, I would venture to say, one of the biggest reasons for divorce.
Yes, and if you want a link to the study, somebody asked for it. I'll send it out after for those of you who are attending here today. Okay. Another factor less talked about is you have the legal right to an accurate credit report. We often see things online that you should dispute negative information here. This is how you do it. But we don't ever talk about why you're disputing negative information. And it's because you have the right to an accurate credit report. So the Fair Credit Reporting Act, often cited as FCRA, ensures your right to an accurate report. It also gives you the right to dispute the information on your report that's inaccurate and requires the credit bureaus to conduct a proper investigation. So what's that mean? What does that mean, Allie?
That means you should dispute inaccurate negative information, right? And one thing that Credit Score Pro has that's really convenient for you is you don't even have to be able to read the credit report and figure out what it is and where's the error and where's the mistakes. Credit Score Pro is going to read that credit report. And here's the catch. It's not just reading the credit report that you're looking at. Okay. Because what you're looking at when you look at your credit is what the vendor decided to show you. Okay. There is a whole bunch of information behind the scenes that you're not seeing that Credit Score Pro does see. So it's looking at information that honestly I wouldn't do. You couldn't pay me enough money to look at it for you individually to look at that credit report, find all those errors in that raw data credit report and do a dispute for you based on those errors. But the awesome thing about technology, and especially AI technology, is it can read that, it learns it, and then it's able to dispute to get the results that you need to get those negative, inaccurate information off your credit report. So it's very powerful in a way that we as me and Ivory as experts in the field, we're not going to take the time. I'm sorry, we're not to read a $500 page document for you to find all the errors. But Credit
And I,
Score Pro will do that.
and I think that's the key. When you see your credit report, it might be 5 pages, 10 pages, but that raw data file on the back end can be 500 pages. It's extremely long. So by having the software read that for you, now you already have the right to dispute the information, but now you have technology reading it for you, creating that dispute. So that way you can send that dispute to the bureaus and they can do that investigation. So you can actually act on your consumer rights instead of just being taken advantage of by this entity that's out
Yeah,
there.
absolutely.
So,
You got power behind you. Power.
yes, exactly. So improving your credit score.
Hey,
Let's
do
talk
we have a key on our keyboard that says that? What's going on here? We all need that key.
right?
Maybe that's our
Click that button.
software design. Our next software design. Create a keyboard with the improved key on it. I love it. I love it.
So here are the rules to live by. Consistency is key. So we want to make sure we're maintaining regular and on-time payments. Set up auto pays where you can. If you have trouble with knowing what's coming in, what's coming out, I encourage you to set up a separate bank account that's just for your bills that you can set up auto pays through. So every month I need to deposit this amount of money in my bills account, and your bills are always going to be paid. If you've ever heard of the envelope theory, you can do that, but with bank accounts, not with physical money. Steady credit utilization. So we advise you to always use your credit cards, but use them responsibly. So that way they don't become stale. So they're active as part of the credit score algorithm, and Credit Score Pro can advise you on exactly how to do that. Credit Scores Pro's action plan will tell you when you need to use a credit card if you haven't used it for a while, and will remind you when you need to pay those balances down if they are not optimal. Regular monitoring. So we had mentioned that Credit Score Pro is connected with Smart Credit. And then our AI platform that Credit Score Pro will do those analysis based on the Smart credit report. And as a reminder, Smart Credit is also going to tell you when the best day to pay your credit cards are. So we've got a combination of tools that allow you to stay ahead of any potential issues. And if it does identify an error on your credit report or new negative information, Credit Score Pro's AI will read that raw data file, help you to determine that dispute, and then you can send that dispute out to the bureaus, either yourself or just through Credit Score Pro's mail integration. Anything you want to add to those first 2 points?
No, but we did have a question in chat that's
Sure.
asked, how do they get started on smart credit? I don't know if you want to answer that or if you want me to. It's completely
Yeah,
up to
go
you.
for it. Why don't you answer?
So what I would suggest that you do is go to creditscorepro.ai and get signed up there because you're going to link smart credit to Credit Score Pro so that you have not just that credit monitoring that we talked about, which is amazing credit monitoring. And I'll dive into it just real briefly on a few of the
Mhm.
features on it, but you get that in combination with Credit Score Pro, and this is your power horse. And you really want to have this forever. So we're in a industry right now, or in a time, I should say, in a time right now where identity theft is prevalent. Information on credit reports is getting put on that's not yours. Like there's just all this stuff that you need to be constantly aware of. And credit monitoring is you kind of really just have to have it. And so with smart credit, having that and then also having Credit Score Pro software for free because you have that, I mean, it's going to solve all those problems, right? But it also with smart credit, you get identity theft protection insurance for $1 million. That covers your entire family. And I'll tell you a brief story. My identity was stolen 2 years ago. They stole 7 grand from me in different means. I was able to get most of it back, but $3,000 of that I never got back. So that was out of my own pocket that I had to pay. So my point of saying that to you is that people rely on, oh, it's a credit card, so I can get my money back. This was credit cards, and the credit card company decided it wasn't fraud on their own bearings. So I did not get my 3,000 back. I had to pay the credit card company that 3,000. And had I had smart credit with that identity theft protection insurance, I would not be out that 3,000. That's huge. When you're
Right.
only paying $39.99 for the credit monitoring with Credit Score Pro, I mean, how many 39.99s do I have to add up to get to the 3,000 I lost, right?
Yeah.
So I think it's important just regularly monitor your credit, always have that, and have it with the AI that Credit Score Pro provides you.
And I think that's a good point to bring up. Right now, we're offering the AI free if you sign up through Smart Credit through Credit Score Pro. Um, so we don't know how long we'll be doing that, but at this time, we want to make sure that everyone has access to utilize this AI. And again, it's free. You just sign up for Smart Credit through Credit Score Pro, and you get access to all of these tools we're talking about today. Okay. So developing long-term financial habits. Credit Score Pro assists you in cultivating these habits as well that are going to positively impact your credit over time. And then you're able to learn and apply those concepts that you're learning. So you have access to credit coaching and the credit management tools tailored to your financial situation. So with the Credit Score Pro action plan, every time you get a new credit report, that action plan can be updated by you. You pick your financial goal, whether that's buying a house or let's say your goal is to pay down debt. And based on your goal, your credit action plan is going to be populated. And maybe let's say you've paid down a credit card. So you're going to rerun that plan and your action plan is going to update consistently. And then at the same time, while you're completing those steps in your action plan, you can be utilizing the credit coaching tab within Credit Score Pro and learn even more about how credit works and how you can make credit work for you. Um, we also have those strategic credit building tools. So the action plan is going to help you with determining what credit building tools make the most sense for reaching your credit goals. And if you want to access the credit building tools, they're also located on creditscorepro.ai, and there's a tab at the top for building credit. The action plan is personalized. So again, it is based specifically on your credit report. It is not a generalized plan. It's not, you don't get the same plan as somebody else across the country. It is specifically tailored towards your credit report and your credit goal. Anything you want to add there? Did I miss any points when it comes to
No,
the action
I think
plan? I know that's okay. Your
no,
main.
yeah, that's credit. The action plan is important, and I think the only thing I would say is if you're going to go lose weight, you're going to want to have your goal, and then you're going to want to have the steps to take in order for you to lose weight, right? I mean, that's common right now with New Year's. It's certainly my goal, but the nice thing about Credit Score Pro is when you put that goal in, and it's not a weight goal, by the way, guys, it's a credit goal. But when you put that goal in, it's going to give you that tailored steps that you need to take. You, need to take, not your neighbor. So if your neighbor ran their report and it says something completely different than your report, don't think that your report's wrong. Your report is tailored to you. That's so important.
Yeah. Yeah, and we really want to make sure you're understanding your credit journey. And really what that means is this isn't about just quickly fixing your score and removing negative information off your report. This is about getting you to that 850 that you want and then staying there. So Credit Score Pro is going to give you those insights, going to help you make the informed decisions, and then empower you with credit knowledge. We want to make sure you're not falling victim to the myths and to the things that you see on the internet. Because unfortunately, while there's a lot of good intention behind it, there's a lot of misinformation out there. So we want you to have the real facts so you really can take control of your credit, get to the score you want, and then keep that score that you want. Because it's about not just improving your score, but managing your score long term. And Credit Score Pro is going to adapt, right? It's going to adapt over time as we see changes in the credit score algorithms or introduction of new credit score algorithms. We're going to be able to update and change the AI so it moves and flexes and bends with the changes in the credit industry. So,
And I think that's really powerful to know because we as consumers don't want to have to do that work, right? We don't want to have to be on top of and read everything about the new changes in the credit industry.
mhm.
And that stuff can get all very complex really fast. And if you can't understand what's going on now, in a couple of years, it's really going to get crazy. So I think that that's important to a key point to note that Credit Score Pro is doing that work for you. You don't have to think. You literally don't have to think. It
Mhm.
is going to do that work for you. And you had made a point about misinformation.
Mhm.
And that's one thing that I really love about Credit Score Pro is that we have that coaching part of the software where you can go and really learn about credit. And I mean the true facts about credit because social media's got all kinds of different myths out there. And like Ivory said, I don't think it's because they're trying to harm. I think some
Right.
of it's trying to like say what you might want to hear so you kind of pull you
Hacks.
in, right?
Everyone has a hack.
Yeah, they have a hack that it doesn't work. But what I think is the worst part, or not the worst part, I wouldn't say worst part. I don't know. It's these are myths that are widespread. So like I have a client that went to a bank and got a credit card from the bank. And the bank said max the credit card out and then pay the minimum payment. That's going to build credit. That's absolutely wrong.
Right.
But that bank teller that told that person that thought that that is the way to do it. You need to know, not think. Know. And Credit Score Pro has the coaching tools in there so you know, not think.
Right. Exactly. That was great. And really, this slide says the same thing in a different way. So I don't think I'm going to really go into it much. But this is really just through the perspective of following these steps to live by, but via Credit Score Pro, right? It has all of those tools that you need to develop those habits, make those good decisions, have that credit education that you did not get in school. That you did not get from your parents and that you did not get training of on the job, especially if you're in the financial services industry. And we want you to be able to be proactive and not just reactive when it comes to your credit. And that's really what we're all about is making sure you have the resources and the tools that you should have, and that were not provided today in society. So,
Yeah. Or you pay a big fee for it, right?
right,
And
right.
maybe
We
it's
want to
not the
eliminate
best.
that.
Mhm.
Accessibility is key.
Yes.
Okay, so we're open for Q&A at this point. So go ahead and start throwing all your questions in the chat. If we have not already answered them, and we'll start going through. I'm going to go back and see some of the questions we had before. Let's see.
And we have a few more minutes that we're going to be on live. So if we do not get to your question, please know that we will privately message you with the answer
Mhm.
to that question. So don't think that your question is not going to be answered.
Absolutely. Absolutely. So question number one is, if I don't have negative information on my credit report, does Credit Score Pro make sense? So I think they're saying, does it make sense for them to use it?
Oh my God, can I answer this one?
Sure, go for it.
Okay. Yes, 100%. You should have Credit Score Pro, not because just because you have negative information, but you or negative information on a credit report. But I guarantee you have a goal. I guarantee you have a goal. And if you don't go make one, it's New Year's resolution time anyway. But you have a goal, and And Credit Score Pro is going to help you get to that credit goal. So if that credit goal is I want to buy a house, or I want to buy a car, or I want to get out of debt, I want financial freedom, Credit Score Pro is going to help you, because remember, it has the tailored plans. But also, you need to know about credit. You may have good credit on accident. Okay. What I call uninformed good credit. Uninformed good credit is great to have. But if you're uninformed good credit, you can uninformedly have bad credit too, right? Very fast. So you want to have informed good credit, or informed bad credit that helps you get to informed good credit. That's what you want to have. And Credit Score Pro will give that to you. But the other thing is remember that it's attached to the credit monitoring. So it's going to be constantly monitoring your credit, and it's going to identify if something does negative come on your credit report, or your credit's pulled and you didn't know about it. This is common day. Unfortunately, we have to be prepared for that. And then remember that inside of your credit monitoring, you have a lot of tools that you can use, like Privacy Master, which is going to run through different websites in the dark web to see where your information is being sold. You need to be taking action on that and getting those off of there from those sites. So Smart Credit allows you to do that. You go on there and it runs a scan every 14 days. Now, if you're really tedious, go in there every 14 days and do it. But if you're not, do it at least once a month. Go in there. It's going to scan. It's going to show you all the websites that your information is being sold on. And you can simply click and say, I don't want my information to be sold on these websites. And Smart Credit will do the job to get those off of there. So there's so much value in Credit Score Pro. It goes way above and beyond disputes. And let me tell you something. Good credit doesn't come because you did disputes. I know a lot of people who did disputes and got all the negative stuff off their credit report and still have bad credit. Okay. So Credit Score Pro is going to prepare you for whatever that goal is that you have.
So we've got another question here, Allie, and it is related to the disputes. So they're saying, I have been trying to fix my credit for a long time. I downloaded some dispute software. I'm saying dispute software. I'm going to leave that software unnamed.
Okay.
And I'm having a hard time figuring out what to dispute. There's so many options. How can I switch to Credit Score Pro, or why? I think they're asking, why would they switch to Credit Score Pro when they're already using another software for
Okay.
disputes?
Yeah, that's a great
Oh.
question. And I think the answer is in your question, right? You're asking a question about how am I going to dispute these things? There's so many options. I'm assuming, and Ivory did not say what software you're using, but I'm going to imagine a few. But I'm assuming your information is going in there, and you have to pick like what dispute letter you're going to write, what's the dispute reason, all that stuff. So I'm going to say switch. Number one, for two reasons. The software that you're probably using is probably more expensive than Credit Score Pro at the credit monitoring fee of the $39.99. So that might be a good catch for you. But number two, the most important thing is remember that Credit Score Pro is going to read that credit report for you. It's also going to tell you what to dispute. It's going to tell you what to dispute and what the reason is. You don't have to do any work. You just have to click and accept, because you are the driver on it. But that's all you have to do. So you don't have to think about it. And these are going to be better disputes than any of those options that you could have picked for yourself.
So essentially, the AI also learns from prior dispute successes and failures from other clients. So as you're using Credit Score Pro, it's going to adjust your disputes over time as well, right? As you get a new credit report, things change on your report, your new dispute will be generated, right? It builds and builds. So the nice thing is you don't pick the dispute reason, AI picks the dispute reason. You just click and send, like Allie said. So okay. Let's look at some other questions we have here. So I see one other question. It's around credit cards. So I don't want to have a credit card, but you're saying that you need to have a credit card for a good credit score. So kind of a statement, kind of a question. This is one of your favorite things to answer, so I think I'm going to let you take that one.
Yeah. Yeah. And I'm sorry, you got to have a credit card. There's no way around it. There really isn't. But using it the right way is the important part, and don't be scared. And I get this question a lot. I get people have had bankruptcies because of credit card debt. They're like, I'm not responsible with the credit card. Totally get it. So if you go to Credit Score Pro, .ai, and you go to the resource section, there's a bunch of resources for different credit cards. One of them is called the Credit Builder credit card. This is a secured credit card. Your financial security is $200. So that's the most that you can get in damage. Okay, so that helps. So you're not having this huge long credit limit. But what I suggest to people all the time, and people love this because they're okay with this part, you're paying for Netflix anyway, right? So what you do is you take that credit card, you pay your Netflix on that credit card, and then have your bank auto pay the credit card off. Hands-free, cut the credit card up. You don't have to think about it anymore. And that's what I would suggest to you or anyone who has a fear of credit cards or anyone who unfortunately has a hard time managing credit cards. Just set it on auto pay on something small like your Netflix, something you're already going to pay. I have some clients that use it for gas, but I mean, for me, I think it's even better not to even think about using it for gas because then you have to slide that card and you have to remember to pay it. Just use it for Netflix. I know you guys got subscriptions. Auto pay them. We
We
all
all do
have them.
nowadays. Yeah.
It's an easy way to use it. Yeah. I hope that made you feel better about getting the credit card, but credit cards are absolutely essential in the credit world. They really are. I mean, like I said before, you can have good credit and have credit cards and no loans, but it's not as likely when you have just loans and no credit cards. And part of that's that longevity of credit. Right?
Okay, I think we'll wrap that up here for the last couple questions, just because I just realized we're definitely over on our time.
Our time. Sorry, guys. We love it. We could stay on here forever for you, but we will get back to you on the questions, we promise.
Yes, yes. So our key takeaways today are understanding your credit score is empowering, and you can do something about it. Small changes can make a very big difference, and it's important to stay informed and proactive. And Credit Score Pro AI will help you do all of that. So visit creditscorepro.ai for credit building tools, access to our AI credit action plan, access to our AI credit disputes, access to credit coaching, and access to ongoing smart credit monitoring with Smart Credit. And join us every other Thursday to learn. And if you want to learn with others, go to our Facebook group, Credit Score Pro, the AI Credit Revolution. On our Facebook page, you can pre-register if you would like to be here live. Otherwise, you can just watch the lives on Facebook or on YouTube. But if you want to participate in the chat, we would definitely recommend you registering on the Facebook group, which is just Credit Score Pro. So we will see you in 2 weeks.
Thank you, guys. Have a great evening. Thanks for taking your time to spend time with us.
Bye, everyone.